8 times a year, 12 people meet in a marble building in Washington and vote on a single number. Within seconds of the announcement, bonds reprice, stocks swing, currencies jump, and the monthly cost of buying a house in Ohio starts to change. One number, moving trillions. Today we follow that chain reaction, domino by domino, using the wildest rate cycle in 40 years as our guide. Here's what most people get wrong. The Federal Reserve doesn't set mortgage rates, or credit card rates, or stock prices. It sets one thing, the federal funds rate, the interest rate banks charge each other to borrow money overnight. That sounds tiny. It's not. It's the price of the shortest, safest loan in the entire system, which makes it the foundation that every other interest rate is built on top of. Move the foundation, and the whole building shifts. Our running example is the 2022 cycle. In March 2022, that rate sat near zero, where it had been for 2 years. 16 months later, it was above 5%. That's the fastest climb since the early 1980s, which makes it the perfect stress test for watching every domino fall. The first domino falls instantly. Actually, it usually falls early, because bond traders move on expectations before the meeting even happens. Short-term Treasury yields track wherever the Fed is headed. The 2-year yield went from about 0.7% at the start of 2022 to roughly 4.5% by year-end. Longer yields rose too, as markets priced in higher rates for longer. The 10-year yield went from around 1.5% to roughly 4%. Now, here's the key mechanic, and it trips everyone up. When yields rise, existing bond prices fall. Think about it. If new bonds pay 4%, nobody will pay full price for your old bond that pays 1.5%. Its price has to drop until the two are competitive. That's why 2022 became the worst calendar year on record for the main U.S. bond index, down roughly 13%. The safest asset class in the room got hammered, purely because one number moved. And notice something else. Short yields rose above long yields. The curve inverted, which is the bond market's classic recession warning, and the first hint of where this chain reaction ends. Stocks feel the rate change through 2 channels. Channel 1 is math. A company's value is basically all of its future profits, translated into today's money. Higher interest rates make future money worth less today, so the same company is worth less on paper, even if nothing about the business changed. And the further away the profits are, the harder the hit. That's why fast-growing tech companies, whose big profits sit years in the future, suffer most when rates jump. Channel 2 is competition. When cash and treasury bills suddenly pay around 5% with almost no risk, stocks have a real rival for the first time in years. Money that had nowhere else to go now has somewhere else to go. You can see both channels in the 2022 scoreboard. The S&P 500 fell about 19%. The tech-heavy Nasdaq fell about 33%. Same economy, same year. But the longer-dated promises got punished harder, exactly as the math predicts. And there's a slower burn underneath. Companies that borrow to operate or expand now pay more interest, which quietly eats their profits over the following years. Money crosses borders chasing yield. When U.S. rates rise faster than everyone else's, simply holding dollars pays better, so global capital flows in, and the dollar strengthens. In 2022, the dollar index rose almost 20% at its peak. The euro fell below $1 for the first time in 20 years. The cleanest illustration was Japan. While the Fed sprinted toward 5%, the Bank of Japan held its rate below zero. That gap made holding dollars overwhelmingly more attractive than yen, and the yen slid to about 150 per dollar, its weakest level since 1990. A strong dollar then exports the tightening. American imports get cheaper, which helps the inflation fight at home. But for the rest of the world, dollar-priced commodities and dollar debts get heavier. One committee in Washington, and the ripple reaches every currency on Earth. Now the chain reaction leaves Wall Street and lands on Main Street. American 30-year mortgage rates are priced off the 10-year Treasury yield, plus a spread. So when Domino 1 pushed Treasury yields up, mortgages followed within weeks. The average 30-year rate went from about 3% in late 2021 to nearly 8% by October 2023, the highest in over 2 decades. Do the math on a $400,000 loan. At 3%, principal and interest run about $1,700 a month. At 7.5%, about $2,800. Same house, same loan, roughly 65% more every single month. Buyers pulled back immediately. But here's the twist. Sellers vanished too. Anyone sitting on a 3% mortgage refused to sell their home and trade that loan for a 7% one. Economists call it the lock-in effect. So sales of existing homes fell to their slowest pace since 1995, while prices stayed surprisingly firm, because almost nothing was for sale. Housing is often called the economy's transmission, because it's the most rate-sensitive sector there is. Construction jobs, furniture, appliances, renovations. When housing downshifts, the slowdown spreads everywhere. The next domino is the smallest and the most personal. Credit cards in the U.S. float on the prime rate, which sits directly on top of the federal funds rate. So every Fed hike showed up on card statements within a billing cycle or two. The average credit card interest rate went from about 15% in early 2022 to over 21% by late 2023, the highest in that data's history. Car loans and home equity lines climbed the same ladder. But there's a flip side. Savers finally got paid. Money market funds and short treasury bills went from paying nearly nothing to around 5%, their best yields in over 15 years. So the incentive across the whole economy flipped, from borrow and spend toward save and wait, for households and businesses alike. Which is, quite literally, the point of the exercise. Every domino so far converges on one target: total spending. Pricier mortgages, pricier credit, shakier portfolios, a stronger dollar. Demand cools. And with less money chasing goods and services, inflation loses its fuel. U.S. inflation peaked at 9.1% in June 2022 and fell to about 3% 18 months later. But this last domino falls in slow motion. Economists estimate the full effect of a rate change takes 12 to 18 months to work through the real economy. Milton Friedman called it the long and variable lags. It means central banks are always steering with a delayed reaction, which is one reason they sometimes overdo it, in both directions. And remember, the whole chain runs in reverse. When the Fed cuts, bonds rally, stock valuations breathe, the dollar softens, mortgages ease, credit thaws. Same dominoes, opposite push. That's why markets hang on every syllable of every Fed statement. Everyone is trying to see the first domino lean before it tips. One number. That's all it is. Bonds reprice first, and prices fall as yields rise. Stocks rerun their math, and the longest promises fall hardest. The dollar follows the yield gap. Mortgages follow the 10-year, and housing follows mortgages. Credit cards follow the prime rate. And a year or so later, the real economy finally feels all of it at once. If you want to understand the next cycle before it arrives, and see these dominoes lined up before they fall, subscribe. Next time, 50 years of inflation waves, and why prices rise and fall in cycles. This is educational content only, not financial advice. Always consult a licensed professional before making financial decisions.